If you want to retire early, you need to know how to quantify the amount of money you'll need so that you know when you're ready, or at least if you're on the right track. I've worked with hundreds of people, helping them build financial independence, and I've simplified what you need to know down to 4 numbers. I've seen people waste time and energy, or worse, delay their retirement because they didn't know what to focus on or how to understand if they're even retirement ready. So let's walk through a simple framework talking about each number so you know what's needed for you to retire. The first number is your expenses. There's just no avoiding this. A lot of resources say to budget your retirement expenses to be 80% of your pre-retirement expenses. I've never seen that one time. I've spoken to so many people about their money, and not one person has ever wanted to budget for 80% of what they currently spend. Nobody wants to scale back in retirement. They all want to maintain their lifestyle. You didn't work this hard grinding in your career to then get to retirement to scale back and spend less money. After all, this is the chance to do the things that you have put off doing while you've been focusing on your career and building the life you want. So you should plan to spend what you're currently spending and probably even more, especially the earlier that you retire. Research shows, and anecdotally it's what I've seen, people spend more than they realize. So I think you should give yourself a buffer and plan on adding about 10% to your current expenses to be your early retirement expenses as a starting point. One tip when it comes to your spending is also know what your wiggle room is. If things change or you need to cut back on expenses, can you actually do that? I'll talk about this more under a later number, but having flexibility and this wiggle room allows you to have a smoother earlier retirement, less stress, and you don't need to have as much saved up. The second number is what are your fixed income sources during retirement? If you're retiring early, it could be years or even over a decade before you claim Social Security. Do you have any other sources of income during retirement, whether it be a pension, or maybe it's rental income, or it could be deferred comp payouts? Get these income sources laid out with a rough estimate of when they start, and if they will end, what year will they end? Okay, so now you know your expected spending, you also know your expected income, and now you can move on to the third number, which is what is the gap or the shortfall between these two. This is a crucial number to know as you plan retirement, and even more so early retirement. If you spend $10,000 a month and your fixed income is $5,000 a month, you have a $5,000 a month gap or shortfall, or $60,000 a year. This gap is what you're going to need to fill through your savings and investments, which brings us to the fourth number, what I like to call your magic number or your gap multiple. The most common approach to fill this spending gap in retirement is what's known as the 4% rule. This is more of a guideline based on research showing that if you're invested in a mix of stocks and bonds, you can withdraw about 4% of your investment assets each year, increasing that each year for inflation, and not run out of money over a 30-year period. They tested this withdrawal rate across a number of terrible financial times and economic periods, and this 4% number is what withstood all of those times. Now, a lot of very smart people can debate this. They can look through the data and say, hey, is 4% too much? And really the safe withdrawal rate should be 3%. Or is 4% too low? Because a lot of these scenarios, taking only 4% out of your assets, you end up growing wealth over time, which means you probably didn't spend as much and enjoy your money as you could have. I'm going to do a separate video on that topic, but right now we'll go with the ballpark of about 4% as a good starting point. The way my mind works, I like to take the opposite of this percentage rule and flip it into a multiple rule. So instead of thinking about 4%, I like to think of 25 times, meaning I need 25 times my gap spending in assets. It's the same exact thing as the 4% rule, it's just reversed. So if my shortfall is that $60,000 number I mentioned earlier, I need $1.5 million in investment assets to fill that gap. Conversely, if my personal shortfall and my gap is lower, say it's $20,000 a year, I would only need $500,000 of investable assets. And if I have no gap, I look at number 1, my expenses, number 2, my fixed income, and those are equal or even higher for fixed income than my expenses, then I'm good. You're all set and you can retire right now. Now, if you're targeting an earlier retirement than traditional, let's say 55 or younger, I actually prefer to see this gap multiple or this magic number be higher than 25 times. I like to see it more like 30 times. And that's simply because you need your assets to last longer. One of the biggest mistakes I see with people planning early retirement is they take that 4% rule and they use it as gospel and think, oh, that just applies universally. No matter when I retire, I can take 4% of my assets out. But that's a very different picture for somebody retiring at 25 or 35 than somebody who's 65 or 70. Just remember that 4% guideline and those research papers are based off of a 30-year time span, not necessarily a 60-year time span if you're, say, 30 or 40 wanting to retire right away. So to go back to this person with a 60K shortfall or a gap, that 30 times multiplier would now be $1.8 million. The ideal magic number for you, or gap multiplier as I'm calling it, is going to be personalized and based off of a few different factors. One is, how much certainty do you want? Some people, as they plan their retirement, they want to know that their magic number withstood the test of all times. No matter how bad it got in our economy, they wouldn't have to make a big adjustment to their spending. Other people are okay with less certainty and they want to get as quickly as they can to retirement. They don't want to keep putting it off and trying to save to get to some perfect number that they may or may not get to, and that there's so many unknowns they just want to get out and retire right now. And they're okay with a little bit less certainty. Say a magic number that withstood things 70 or 80% of the time. Everybody's a little bit different with how much certainty they need. Or you may have a goal to leave assets or a legacy for kids or family, and then you might want to have a different magic number, knowing that you want to have a buffer at the end of your life and not spend down your assets too quickly. Conversely, some people have a goal of dying with zero, spending their assets, living their best life possible, and their personal magic number or gap multiplier should reflect that. Another factor I mentioned earlier is figuring out how much wiggle room you have in your expenses. This is important because a lot of the research papers are based off of a linear and ever increasing with inflation spending. This is not how most people live their life and spend their money. If you have more wiggle room, meaning if something happens in the economy or the market and your asset levels drop, so your portfolio goes down in value, could you adjust? Could you take out a little bit less money for a few months or a year or 2 years, whatever it might be, to protect your portfolio from spending down too quickly? If you do have that flexibility, that's great because it provides a little bit more certainty entering retirement, and as well, it will help make sure that you don't need as much money entering retirement. So if somebody has more wiggle room and flexibility, their target magic number very well might be something like 20 times their gap spending. That might be more than enough that they need, knowing that, hey, I'm going to take more out of my assets right now, a higher percentage than some of these rules say, but that's fine because if something changes or I'm going down a path that's not looking perfect, I can just adjust. A final consideration that I like to think about for this magic number is the composition of your assets or the tax status. We all can have very different mixes of our portfolio. You could have pre-tax IRA money or 401k money. You could have completely tax-free Roth money or HSAs, or you might have money in a taxable brokerage account or even a chunk sitting in cash. Each of these has very different access in terms of what age you can access the money and will there be any penalties or restrictions, and very different tax implications when it comes time to taking money out of these accounts. So taking a look at just your situation, what's the mix you have? Is 100% of your money going to be taxed when you go to take it out? Or is it all going to be tax-free when you take it out? This all can have an impact on what that ideal target magic number for you is. Now that you know what your magic number probably should be and some ways to personalize and customize it to your priorities and goals, you can compare it to where you are right now. How many years out are you from your target age of retirement? What are your goals related to that? And how much growth do you need to get to this magic number? Or conversely, do you look at these numbers right now and you think, I'm basically already there? That's all I've got for today. I hope you found this framework helpful as you think about planning your early retirement. Thanks for watching. I'm Peter Campbell, the lead advisor at Bull Oak. We're an independent financial planning firm based in San Diego, but we work with clients all across the country. If you want to learn more about how we help our clients, check us out at bulloak.com. Thanks.